Vinit Sambre joins us now, Head of Equities with DSP Mutual Fund. Vinit, oil shock, that's the term which we are using. It is, if oil prices go up by $20 or 20%, it is clearly a big shock. Are markets prepared for this? Or this is something which will also go away?
Hello.
Vinit, is my voice reaching you?
The voice is very low, feeble.
Okay, this is Nikunj from the studio. Can you hear me? Good morning.
Yeah, hi Nikunj, I can hear you now.
Well, when oil goes up by 20%, it is better that I keep my voice feeble, right?
Yeah, sure. Everyone has to keep the voice feeble.
So what is your view? Do you think markets will remain feeble because of oil?
So clearly, I think anyways we are facing currently the slowdown which is impacting most of the businesses, and oil was supportive this while. But if oil also starts to play a spoilsport, then I think that will have its own little bearing in terms of higher cost, higher input cost, and that and also it will fiscally it will not be positive for the country. And as such, that would not be a positive factor as far as our economy is concerned.
Vinit, what is the right way of looking at the current market? Macros are great and micros will get better, or after this oil shock, both macros and micro will be under pressure, and we may not see anything big, special, grand for the market for rest of the year?
See, by and large, I sort of agree to the view that given the current slowdown which we are witnessing, and let's say if oil also starts to flare up, those will not be good indicators as far as we are concerned. Anyways, we are not seeing the uptick as far as the results are concerned. Whatever little data we are able to capture or gather, the festival season till now has not been able to gather a lot of steam. So I think all indicators are pointing towards continuity of this slowdown, which has been prolonged for a while, and hence going with the existing setup, I think it becomes slightly tough from the market's viewpoint. But at the same time, really from the from the investing sort of a thought process, the price points which we are seeing in across many sectors, many companies, I think those are also getting onto a reasonable levels versus what it used to be in 2017. So from the long-term investment viewpoint, for the investors who have patience, who can sit through and see the volatility for a while, I think this also makes a case for such types of investors to start nibbling and looking at the markets at the current juncture.
Vinit, you're a mid-cap specialist. You have a small-cap fund. How's that end of the market looking? Do you think there is more pain left? You know, I met an analyst from one of the brokerage firms, and his view was that yes, mid-cap stocks have fallen, but valuations have not fallen. Mid-cap stocks are still trading at a premium to the historical P multiples. Is that true that mid-caps have fallen, but they are not cheap?
So I think select mid-caps, by and large, most of the mid-caps have fallen. Some of them have become quite reasonable as far as their historical valuations goes, but there are a couple of them which have still not seen a decent correction yet, and I think that's one category which probably is not as cheap as some of the others, and hence ideally from the investment viewpoint, I think it will be ideal to look at the companies which have got down to interesting levels in terms of the valuations, and still probably wait a while for the ones which still looks on the expensive side, and given the slowdown, given that the earnings are likely to disappoint, there is a chance that the ones which are trading at the expensive zone may sort of cool off a bit.
Vinit, just assessing then as an investor, what is the right approach? Do you already begin to hunt within the small and mid caps because that's where valuations are attractive and there are some growth stories, sure? Or do you wait it out, wait for the froth to settle down, see those green shoots emerge when it comes to growth, when it comes to, you know, just overall sentiment, and then begin buying?
Yeah, I think it's a very important decision which sort of every investor is trying to find an answer to. And to me, it has always been difficult to wait till the last point. And the moment one starts seeing green shoots of recovery, the price points won't be as attractive as what you see today. Or probably it may, like you said, given the slowdown in the economy, given that the earnings are going to disappoint, there is a fair chance that before the recovery we may have to see some bit of a down dip as well. Who knows? I mean, what will be the lowest point in terms of the markets there? But by and large, the long-term investments is all about investing in the bad phase, so to say, by and large, and try to identify pockets of attractiveness in this turmoil. And start to look at investing because if you look at the small caps particularly, it has got corrected significantly in the last 1.5 years or so, and the valuations there also look pretty okay right now. So as I said, there's a fair chance given the where we stand as an economy, given that the earnings are not coming through, and given there is clear visibility that the turn will take a while. There's a fair chance that they may see further correction, but the ideal stance would be to start looking at it now and keep gradually investing into these companies.
So Vinit, give me an example of where do you think markets are not paying attention to either valuations or the strength of the business, and pure technical factors and liquidity have taken those businesses down. That's one pocket. Second pocket is, where do you think markets currently are overpaying for the growth because there is near-term visibility? Both the answers, perhaps, but very different ends of the market you'll have to answer with.
So clearly, I think the pockets where the stock seems to be overpriced today, given the fair degree of visibility, near-term earnings visibility these sectors are showing, includes the likes of the FMCG, the retail category as such, and a few private sector NBFCs, so to say. But other than that, if we were to by and large look at many other categories, I think they have seen decent corrections. Including, let's say, the auto ancillary, building materials as a category, healthcare as a category, where selectively we are looking at opportunities in those categories. So I think excluding the fast-moving consumer goods or some of the retail companies and some of the private sector NBFCs, the other categories are fairly cheap.
Interesting, Vinit, that you actually find opportunity within auto and auto ancillaries. I mean, I understand that valuations have really, halved over there. It's the most ignored sector, the most hated space right now. But would you say, A, where do you find opportunity within auto and auto ancillaries, considering such a diverse space? And B, would it have to be a long-drawn investment plan, wherein even if you buy today, you can't expect returns to come out even in the next 6 months, or for that matter, 1 year? It has to be a more stretched time frame.
Yes, I think the auto ancillary are looking attractive from the price point. Like you said, the stocks have seen massive corrections, and rightly so. The reasons have been pretty solid, where we are sensing slowdown not just in India but globally. But by the way, we have a lot of these strong brand franchise. They have created extremely good brands in India. There are many auto ancillary companies which are globally competitive today. They are not just catering to the Indian markets, but are looking at some of the global markets. In terms of the mix itself, there are a lot of OEs which are purely not dependent upon the OE demand. There is a huge amount of replacement demand which they can cater to. So I would say that within the auto ancillary as such, there is a diverse set of business which provides some bit of cushion in this slowdown. Like you said, I think the wait period may be slightly longer. People may want to have some clarity around whether there is going to be any regulatory support which is going to be there in terms of GST cut. People are wanting to see what happens to the price point post the BS6 implementation. I think post those type of clarity emerges, we would expect the cycle to sort of start gradually coming back. And mind you, with the fall which most of the OEs are witnessing in terms of the monthly demand, the low base is also getting created. So for achieving a slightly reasonable growth, they will not have to look at a high number, so to say, when eventually the demand starts picking up. So to me, I think the reversal, whenever it happens, it can provide a decent opportunity for the investors who are looking at the category. There are this category as such is disregarded today. Given the valuations where they stand.
A pocket where you're looking that you're looking at positively is also healthcare. Just talk to us about the rationale there, and if there's any particular strategy that you're putting in place when you're looking at some of these healthcare names.
See, healthcare in a way, in today's environment, actually it solves two purposes where people are sort of worried about overall markets and many categories, reporting low number. Healthcare relatively fits the bill well, and anyways, there are many companies which had seen issues around their US FDA related inspection related issues. There was generic pricing issue. And many of these companies, we are witnessing that they are coming out of these problems which they had seen 3-4 years ago. So I think selectively it makes a case to look at these companies as they are coming out of the problems. Beyond that, there are domestic focused companies, and I think domestic market is gradually picking up, is our sense. And by and large, the domestic oriented companies tend to have a very strong balance sheet. Their return ratios tends to remain very strong, and because of the overall healthcare as a sector which is sort of out of flavor for the last 3-4 years, the valuations are also sounding pretty reasonable. So I think due to these factors, it makes a sense to have some bit of allocation to the healthcare sector as such.
But are you not cognizant of the fact that the generic prices is still not very stable? A. B. Amazon is planning to enter into the US generic market, and when Amazon will enter into the US pharmacy business, God knows what will happen to further pricing.
So yes, we are cognizant of the fact, and we are just looking at the slope of the price point. So if we look at the generic price price change in the last 2 to 3 years, there was a massive decline 1.5-2 years back, and now that decline actually has got arrested. There are many companies globally which have sort of withdrawn from the products which are not remunerative for them. Which means that probably we can assume that from the price pressure point of view, I think we are reaching sort of a trough in some sense. Indian companies being pretty competitive in terms of their cost competitiveness, I think there's a play for the Indian generics in the US market as such. And also we have started witnessing, not in a huge way, but the companies, Indian companies which are getting to look at some of the US opportunities, they are trying to grab a decent share of the market there. So I think irrespective of the fact that the generic pricing pressure has not fully abated, but I think there are pockets of opportunities. Definitely we are cognizant of the fact that this is one sector where the regulatory overhang will always remain pretty high, be it Amazons of the world, be it the own government's changes as far as the pricing are concerned. So one will have to remain alive to those facts, and those risks will always be there. But by and large, I think risks are there everywhere now. I mean, for every businesses we have disruptions which are taking place. So one has to look for strong brand franchise, good balance sheet, great cash flows, and great management. I think that's the only way one can probably relatively do better over a long period of time.
Tactically, do you have an internal mechanism in place at DSP wherein there are parameters that you're going to be looking out for you to be able to analyze whether sentiment is really turning the corners? What are those three things that you're looking out for?
So we have a team of analysts, and they are constantly, beyond the management meetings, we constantly keep doing the parallel checks in terms of the dealer checks, going on the road, trying to meet the large set of people who are important part of the value chain. And trying to sort of assess the first-hand information as to what's really happening. Are there changes which we can foresee? As of now, our whatever little checks we are carrying out, it is still not showing encouraging trends as yet. Despite the beginning of festival season, we are not sensing a big change in the trend as far as the demand is concerned across various categories of good. So I think it may probably, from at least our assessment, it may require more measures, concrete steps, probably in terms of the policy related changes, in terms of the push from the government, or in terms of confidence boosting, which is really required, which will create that virtuous cycle of improvement in the demand.
All right, Vinit, appreciate your time and glad you could join us.